The ADP report coming in weaker than expected for September, raising some concerns about the strength of the labor market heading into Friday's jobs report. Jared Blickery here with a look at why, good or bad, however the data comes in on Friday, could be bad for stocks. Jared, please explain.
Okay, Julie, you might recall yesterday I was at the New York Stock Exchange with Alfonso Pecatillo, the proprietor of the Macro Compass, and he was outlining his argument for why markets are about to crack. They have not yet, but because of the Fed's tightening and because we are at the stage of the economic cycle when growth is slowing down, this could cause problems. It could cause a major disturbance in the market like we saw in late 2018 or even in the global financial crisis, which would have been much worse. Now, we don't know how this is going to evolve yet, but let's go to the Wi-Fi Interactive and map out some scenarios here. I'm going to start with the 10-year. We have yields at 4.73% in the 10-year tenor. This is up markedly just from where they were earlier in the year. This is a year-to-date chart, and you can see there's really been an acceleration over the last few months, and that occurred when we got just above 4% again. That's been an important threshold, and you can see it's been from the lower left to the upper right over the last 3 years. But this tightening that we've seen in here, what is called a bear steepener, that's when treasury prices are going down, sending rates up, and also making the yield curve less inverted, more steeper than it used to be. This is ripe for causing a credit market dislocation. And as further evidence, let me just show you what's happened to the yield curve over the last few months. Since the end of the second quarter, this is what the yield curve was looking like in the shorter maturities, all the way to the 10-year, all the way to the 30-year. It is shot up, and you will see now it's actually quite a bit less inverted than it was. And we know that typically presages a recession. Now, if the report comes in super hot, guess what? That doesn't say recession. That says maybe the economy can hold higher rates for higher, and when we might see the 10-year north of 10% or 5%, excuse me, with yields north of 5%. And this is what Macro Alf was saying yesterday. This causes big problems for equities. So stocks could end up going down just in anticipation of what that does to the credit markets. Now, on the other hand, if the report on Friday comes in really weak, let's say a negative print, well, that just means that recession might be around the corner. Nobody's priced that in yet, and so that could be a negative omen for stocks. Now, if it comes in Goldilocks, kind of in the middle, I'm going to say we probably just kick the can for a later catalyst. But I will say, Macro Alpha is very adamant, pounding the table that this is a late-stage credit event, and we are at the precipice of something happen, and we are just awaiting a catalyst.